Nashville, Tennessee. This is Mike Swanson. Hope you're having a great day. We're going to get started now. We still have a few folks joining, but we're going to try to be prompt and respectful of your time. So today's webinar is Law Firm Finance 101. I'm broadcasting to you live from Music City. This week we're also known as the Solar Eclipse City. We're one of the few large metropolitan areas that are going to experience a full solar eclipse on Monday, so we're pretty excited about that. I'm going to start with a disclaimer. This webinar is for information only and to help you if you're a plaintiff lawyer. If you are considering taking any actions or stopping taking actions based upon excuse me, what you hear today, be sure to consult with your professional experts before doing that. Speak to a lawyer, speak to your CPA. You can even share this with them. You're going to be recording of this as a video link in a couple days, and you can share that with them if you have questions for them. Today we're going to talk about what they didn't teach you in law school. Most of you, if you're a plaintiff lawyer, probably have your undergrad degree in history, English, political science, things like that, so you didn't learn about business in your undergrad, and most likely they didn't teach you that in law school. So you're thrust into being the owner of a small service business called a law firm. So we've put together information to try to help you serve your clients better. So we're going to talk about various business topics today. My expertise or bona fides for presenting this has to do with the business that I'm a part owner of. I'm one-half owner of Advocate Capital, and our mission is to help an ever-increasing number of plaintiff lawyers get even better results for their clients. So I've been, my team and I, we've been reviewing the tax returns and financial statements of plaintiff lawyers every day for the past 17 years. So we have seen it all. We've seen the good, the bad, the ugly, and today you'll learn about some of the mistakes other people have made so you can avoid them. I also wrote a book called How David Beats Goliath. You'll see that's kind of the theming of the slides today. I donate all the profits from this book to the 7th Amendment Fund at AAJ. It's not to make a profit, it's to give back to our plaintiff lawyer community. Okay, today we're going to talk about a few different things. Here's the outline. We're going to talk about a couple basic financial statements. I'll walk you through a balance sheet and an income statement. Then we're going to touch briefly on the 10 most common forms of capital, or money, that plaintiff lawyers use to fund their practice, mainly case expenses. I'll go into a recommendations section for you, some general recommendations, and then we'll also speak about some loan-specific recommendations if you're entertaining a loan or looking for a source of capital through borrowing. I'll give you some help with that because that's what we do. My goal today is to help you learn one new thing and take away 3 items that you can apply immediately at your law firm to improve your financial situation and therefore improve your ability to serve your clients and get results. Okay, we're going to get started. Financial statements. We're going to talk about a balance sheet first. But before we talk about it, I'm going to ask you a question. So I'm going to launch a poll right now and ask you a question, which is, what time period does a balance sheet cover? So your screen should now show the possible answers. It's multiple choice. Does it cover 1 week, 1 month, 1 year, all of the above, or none of the above? So what period of time does a balance sheet typically cover? And I'll give you a moment to vote. Your votes are anonymous, so I can't tell you, I can't tell who you are. I won't promise not to give any names away. Okay, people are beginning to vote. Votes are coming in. I'll give you about another 30 seconds. And people are still voting, so I'm going to let that continue, just another 10 seconds or so. Okay, we're going to close that out, and the voting is in. So half of you got the right answer, and this is kind of a trick question because a balance sheet does not cover a time period. Some of you said 1 month, some of you said 1 year, some of you said all of the above. About half of you got the answer right, which is none of the above, because a balance sheet is a snapshot at a point in time. It does not cover a period of time. Sorry if I tricked you on that. All right, let's look at a balance sheet and what it's made up of. So I like to think of a balance sheet as a quasi financial statement that shows you net worth. And you can think of net worth as what you own minus what you owed, and net worth is what's left over. Well, we don't use those terms on a balance sheet. You'll see different names for those. So what is owned, we call assets. What is owed, we call liabilities, and the net worth we call equity. So those are the 3 terms you'll see on a balance sheet, but we don't really arrange them that way. If you look at a balance sheet, you'll see they're arranged differently. Here's a sample balance sheet. At the top, we have the assets. That's the items that are owned that have value to the law firm. at the bottom, we have a combination of liabilities and equity. So it doesn't quite look like our formula, does it? We're going to take a look at why that is. So the formula that you see on a balance sheet, it looks like instead of assets minus liabilities is equity, we do a little algebra here. We're going to add liabilities to the top and bottom part of the equation. So that cancels out liabilities from the top, and that's why the balance sheet looks like this. It looks like assets with liabilities and equity at the bottom. Why do we structure a balance sheet that way? It seems confusing, I think, anyway. Well, we'll take a look at that balance sheet again. You see assets at the top supported by liabilities and equity, and it has to do with that support concept. So the liabilities are at the bottom with the equity supporting the assets at the top. Well, where do assets come from in a business? Right, things that are owned. What's the source of things that are owned? Well, there are only two places, two sources of capital to acquire assets. First is liabilities. That's borrowing, right? If you have a bank line of credit or you have other accounts payable, things like that. So you've brought money into the business or deferred the payment out by creating a liability. The other source of assets is equity. So equity is either the paid-in capital from the owners at the start of the business or ongoing, or the retained profits in the business. So that's why we structure a balance sheet this way. Assets are at the top, they're supported by liabilities and equity. Okay, question. When you look at your balance sheet for your law firm, what is your law firm worth? What is a contingent fee law firm worth? Very difficult to say. The balance sheets we see are very, very thin in the way of assets. Most contingent fee law firms don't own much in the way of assets. They typically rent their office space, they may have some furniture, they probably lease their equipment and this kind of thing, so you're not going to see much in the way of assets. You may have actually more liabilities than assets. So we typically see the balance sheet is presented from a law firm, very, very small number. Most of the net worth and our typical customers, for example, is outside the law firm at the guarantor level. So don't feel bad if you look at your balance sheet and there's not a lot of equity there. That's pretty normal. The challenge that causes for you, as you know, though, is if you take that balance sheet to a lender and try to get a loan, they're going to say, let's put a lien on your house. So what is your law firm worth? It's what another lawyer would willingly pay for it. Hard to put a number on that. All right, let's look at the income statement. And let's do another poll. This one might be a trick question. It might not. We're going to say, what time period does an income statement cover? Is it 1 week, 1 quarter, 1 year, all of the above, or none of the above? And I'll give you a few moments to vote. The votes are beginning to come in. Okay, people are still voting. This is fun. I like this voting part. Okay, a few of you haven't voted yet. Come on, don't be shy. Multiple choice, no one will know what you answered. There we go, a few more votes coming in. I'll give you about 10 more seconds. Just take a guess. Okay, we're going to close that out. Well, as with the last poll, half of you got the right answer, which is all of the above, because an income statement covers a period of time with a starting point and an ending point. So that could be 1 week. You could look at an income statement for a 1 week time period, a quarter, a year. So all of the above qualifies. And half of you got that right. The rest of you, don't worry. You learned something new today, right? All right. A typical income statement is basically what you received minus what you paid out, and what's left at the end is a profit or a loss, right? We don't call that use those terms in an income statement. We say income is at the top minus expenses equal profit, or sometimes a loss. Here's a typical profit and loss statement for a law firm. You see the income at the top, we have expenses below that, and then at the very bottom is the profit. Okay. Pretty simple. It's a little easier, I think, than the balance sheet in concept. Most people can conceive of that pretty quickly. All right, next we're going to talk about the 10 most common forms of capital that are used by plaintiff law firms to fund their practice, mainly their case expenses, but also working capital. We're not going to talk about all of these today. We're going to talk about just a couple of them. If you'd like to learn more about all of these, each one of these is a chapter in my book, How David Beats Goliath. So pick up a copy of my book. In fact, for attending today, if you'd like a copy, I'll send you one. I'll even autograph it, and you can learn more about these in depth. We're just going to touch on a couple of them today. Well, I've presented these to you in alphabetical order. I'm not going to read them all to you. You can read them for yourself. What I'm going to ask you right now is, which of these do you think is most expensive? I don't have a poll for this one. If you want to, you can use the chat or the questions section. Chat would probably be best to pick one, or you can just write down or think in your mind which of these you think is the most expensive when it comes to the economic cost. What is the most expensive? Okay, you got the idea in your mind of what you think is most expensive? Okay, well, I'm going to share with you that of all of these, fee sharing or co-counseling a case is potentially the most expensive way to access capital for your cases, and I'll explain. There are positives to fee sharing or to co-counseling, right? There's no collateral requirement, no underwriting, you can have bad credit, there are no monthly payments, there are typically no UCCs filed, and there's a certain amount of risk abatement because most likely the firm you're co-counseling with is taking on some of the risk of a loss with you. It's also very comfortable because you're going to be working with another law firm, probably a friend of yours, so there are some positives to it, mainly economic, non-economic, except for the risk abatement. There are negatives, though, to fee sharing. It has a high effective financial cost. And the effective annual interest rate for a typical co-counsel arrangement, if you just look at the finances, can be between 50 and 150% effective annual interest rate. Let me give you an example and show you that. So here we have an example of a case. This is a case that has a total value of $100,000. There are going to be $10,000 in expenses. There's a 33% contingent fee, and all the expenses are advanced by the other firm. There's a 50-50 split on the resulting fees, and the case lasts 1 month, assuming the motivation here is purely getting access to the $10,000 of cash for the case expenses. What do you think is the interest rate? And I thought I had a poll for that one. I guess not. We'll do a poll next time on this one. So do a little math. I'm going to give you 30 seconds or so to think about that. So what do you think is the effective annual interest rate for getting access to the $10,000 for a year? Well, it's very high. In fact, it's actually about 148.5%. And the reason is, what are you giving up? You're giving up half your fee, which is so you're paying $14,850 to the other firm only to get access to the $10,000 of expenses, right? So $14,850 divided by 10,000 is 148.5% if it's open for just 1 year. So it can potentially be very expensive if you're co-counseling primarily for the economic benefits. You could be paying a very high effective annual interest rate. Take a look in the rearview mirror at cases you've done with other firms and do a little bit of math and see what you've been paying, maybe a lot. Conversely, if you're a firm that has access to plenty of capital for cases, there are probably some folks in your town who are signing up good cases but don't have the economic wherewithal. You could partner with them, earn a nice fee, but also effectively, by putting $10,000 out for a year, earn a fee of $14,850. It's a pretty good return on your investment there. All right, let's look at partners cash as one of the forms. This is the most common form of law firm financing that we see out there. The partners just loaning their own cash to the business or leaving their cash in and letting the law firm use it to fund the operation. Well, there are positives, right? There's no collateral requirements, no underwriting, no monthly payments. You can have bad credit, no problem. There are no UCCs filed. It's very comfortable. You're used to doing that. There are some negatives, though, and the negatives have to do mainly with opportunity costs, the time value of money, the fact that you're going to have phantom profits, right? Because if you're sinking money into cases, that's your own money, that's your after-tax cash you're sinking in. You've made profits, and now you don't have the cash to pay your taxes, and it can cause low liquidity. The effective annual interest rate, our best estimate is probably between 6 and 10% based upon your opportunity costs. In other words, what could you be doing with that cash if you got it out of your cases and into some other investment? But it could be much higher as well, depending upon your investment opportunities. Well, now I want to talk about the least expensive form of law firm finance, and that is a loan with interest pass-through. And full disclosure, this is what we do at Advocate. This is not necessarily a pitch for us, but this is what we do. The AdvoTrack Case Expense Funding Service enables a law firm to have a loan with interest pass-through because of our technology and our service team. So it's typically going to be a non-bank finance company like us with the pass-through of borrowing costs to the cases. Well, there are some positives there. The main positive is it's the lowest net form of cost of capital that's available to you in the marketplace. Because the cost of borrowing is going through to the cases, your cost of borrowing is zero for the cases you win. No law firm wins every case, so there will be some cases that you're not successful on, you don't get your interest back, but we find that the average net cost of borrowing for our clients is less than 1% a year. A couple other benefits, you can typically get a little higher leverage than at a bank. There are negatives though, right? You have to have good credit. You're going to need to pledge your accounts receivable. There will be a UCC filed. There will be additional reporting like sending in financials and things like that. There would be monthly payments that are offset by your case recoveries. And you're dealing with non-lawyers. Unlike fee sharing, you're going to be dealing with finance people, and sometimes that's intimidating. Also, there is underwriting, so you're going to be examined every year by the lender to make sure you're in good financial shape. So this is not a solution for law firms that need money, right, that are having trouble. It's more of a solution for a well-established, successful law firm where the owners have good credit. All right, so that's an overview of some of the forms of capital that people use. If you have questions, by the way, while we're going, you can type them in the questions box. I'll try to take a look. And we do have one. Oh, great. Bill, I won't mention your last name. Guest Partners Cash on the previous question. I'll do a poll next time. I think that would be better, right? All right, let's get started now with some recommendations that I promised to give you. And a lot of these recommendations are based upon what we see every day and have been seeing every day, reviewing law firms, underwriting them, and seeing mistakes that are made. And so it's always easier and cheaper to learn from other people's mistakes than to make them yourself, right? So these first batch are going to be general recommendations for your law firm, and some of these apply to your personal life as well. So the first is to minimize interest. Interest is money you pay, essentially, to rent someone else's money. We're familiar with the concept of renting an apartment, right? We pay so much rent each month, we get to use the apartment. Well, interest is really no different than rent, right? You're paying so much every month in interest in order to use someone else's capital. Once you get up and running and established, you should be looking to pay as little interest as possible. Ideally, none. Ideally, you have no leverage, either personally or from a business standpoint. The only debt I would have if I were a plaintiff lawyer would be that associated with my case expenses, and only because the cost goes through the case, so there's no cost, net cost on the cases I would win, and as the cases come in, they kind of automatically pay the line down. So if you're having a tough year, rather than a normal line of credit, which tends to go up during a soft year, your case expense balance will tend to follow the porpoising of your revenues in your cases. So take a look at least once a year, look at your business income statement for the year, look at your credit card summary statements for the end of the year, and see how much rent did you pay last year to use someone else's capital, and how can you avoid that? One of the ways you can do that is to pay off credit cards. Far too many people carrying large balances on credit cards can be very expensive and even dangerous, economically speaking. We see law firms in the beginning bootstrap stages that will come to us that have balances on 10 credit cards, and they've basically been using credit cards to fund their practice. You know, it can work, I guess, for a while, but it's very expensive. The net cost of borrowing is going to be in the teens. There are a few other dangers. If you have a lot of credit card debt, it can affect your credit score adversely. That affects the price you pay for everything from a lease to a mortgage. And also, banks have the ability in the fine print to lower your credit limit unilaterally. And that happened a lot during the financial crisis. We saw folks who were in good stead, great credit score, had maybe a $5,000 balance on a $10,000 card. The bank unilaterally says, we're going to lower your limit to $6,000. Now suddenly their overall percent used of their available credit shot way up. What does that do? Lowers their score, and it's kind of a vicious circle, right? Also, in a credit card situation, if you have a balance, most of the fine print enables the credit card company that if you forget and miss one payment, or the stamp falls off your envelope you mailed, or whatever, and you miss a payment within certain parameters, they can automatically increase your interest rate to as high as 29.99%. So there's a lot of danger maintaining credit cards. Ideally, if you're going to use credit cards, I use one. I like to get airline points, fly my kids around the country, but pay it off every month. Having a long-term credit card balance set as a symptom of something wrong. So live more within your means maybe for a little while, get those paid off. All right, credit score, I mentioned that before. You should know your credit score. There's no excuse for not knowing it. You can get it for free once a year from all 3 agencies that are out there. I like a product called myfico.com because I set it and forget it. They email and text me quarterly with updates. I don't have to remember to log on. And then they have some great tools on the site to help you increase your score and work it up higher and higher. A good target score is 800. It's challenging to get there. You definitely need to be above 700. Our average client score is about 722. If you're below 690, there's a problem, and you're going to be paying a lot higher price for a lot of things that you're buying from an economic standpoint. So it's not difficult. It just takes a little time, but not that much. So you should know your credit score. Another really important guideline, we see this all the time. Do not wait until you actually need money to look for outside forms of capital. So often, just yesterday, we had a fantastic lawyer come to us just having a tough year. You know how it can be. You know, the timing, he had 3 mediations pushed out and didn't get the payments he thought he was going to get, and he waited till he was in a cash crunch to start looking for capital. Well, when you do that, your options will be very limited. Most of the traditional lending, banks, things like that, they're not there to bail you out when you're having a bad year, and so your choices are going to be some of the very high-priced non-bank lenders. You can end up paying 15, 20, 25% interest rate because you waited. So you might not feel like you need capital right now. Think ahead. What if I want it next year? Wouldn't it make sense to arrange for capital while you're having a great year? It's going to be a lot easier. You'll get a better facility. You'll get more people competing for your business. So don't wait until you need money to look for it. An emergency fund is so important. This is probably one of 2 best pieces of advice I can give to anybody, whether they're a plaintiff lawyer or not, and that is to have an emergency fund. So you should have an emergency fund equal to, I think, a minimum of 6 months of cash in an FDIC-insured bank account, sufficient to pay your ongoing living expenses. So you should have an emergency fund for your law firm, in my opinion, so that you could operate in case you have that 2 or 3 months where, wow, everything just, the planets align and you get no cash in the door for 3 or 4 months. That's exactly when you shouldn't be borrowing money, right? So an emergency fund is not a line of credit you haven't tapped into yet. That's not an emergency fund, because you're going to tap into that when you're having trouble, and what you're going to do is dig the hole deeper. It's going to decrease your net worth because you're not adding any assets, you're just adding liabilities. It's going to increase your expenses because now you have an interest expense you didn't have, and that's all going to happen right when you're having your downturn, right? So an emergency fund is cash, or something that can be quickly converted to cash that you can count on and know that's there. Same thing for your personal life. You'll hear me say later, you should be building net worth outside your law firm. You should be building net worth partially in terms of an emergency fund for you and your family. You should have at least 6 months of cash built up outside the law firm, out of harm's way, so that if something bad happens to your law firm, you can make ends meet. It gives you a lot more flexibility, and let me tell you, it helps you sleep at night to know that, okay, if something bad happens to my law firm, one of my employees embezzles $1 million, something like that happens, I have the cash outside the business, okay, to carry on with my life from myself and my family. It's hard to do. It took me many, many years to get there. It will probably take you a while if you don't. Live within your means, set aside a small amount each month, and at least have a 2 to 5 year plan to get where you need to be on the emergency fund. Very, very important. Okay, next, if you're going to pay down debt, that's a good thing. Pay down as much debt as you can, but pay down the most expensive debt first. So we see folks who will get a good case in, have some excess cash, and they turn around and pay down, let's say, a bank line with 4% interest rate when they still have maybe an auto loan at 11%. It makes no sense. So pay down the most expensive debt first. I think that should go without saying, but if you're about to pay off some debt, take a look at the interest rates of the various debts that you have and pay down the most expensive debt first. This is some important information about where case expenses should appear on your financial statements. And your case expenses should appear on your balance sheet, not your income statement. More than half of the law firms we see, when they present their financial statements, show case expenses as an expense of the business, right? So they have the fee income, they have other expenses including case expenses, and then they calculate a net profit. The IRS says in Private Letter Ruling 824-6013 that case expenses advanced by a contingent fee law firm for their clients are not expenses. They're not supposed to be deducted from current year income, thereby reducing the tax exposure of the law firm. They're supposed to be booked on the balance sheet as an asset, because what they have opined is that because those case expenses come back to your law firm so consistently, usually 95% of the time, right? Because they're going, they're going to come back 95% of the time. That's not an expense, that's a loan. So you've made an interest-free loan to your client for those case expenses, and those should be appearing on the balance sheet. Now, you may think, okay, it's a technicality. Not really, because if you get audited, the IRS is going to look at your tax returns and see, are you deducting case expenses? And if you are, they could make you file an amended return, and they can go back several years, and suddenly you might have a huge tax bill sitting in front of you that could turn into a tax lien, a federal tax lien. You don't want that, right? Death and taxes, you can't avoid them. So be smart, show this to your CPA, get their professional opinion. If you need to make the change, get your case expenses on the balance sheet. There's another reason you want to do that, and that's because you should know how much you have out in the street on case expenses. Probably half of you, if I asked you right now how much do you have out in case expenses, you'd kind of say, well, we spend about $20,000 a month, so I think this or that. Hey, look, you should know. If you're going to make an interest-free loan to your business, you should know exactly how much you've loaned. And you can see that on your balance sheet whenever you create your balance sheet, monthly or quarterly or annually. So you should know that as the owner of the business. I would never allow my business to borrow money from me personally and not know how much I lent it. I can't imagine doing that. So get your case expenses on your balance sheet, but again, as in the disclaimer, consult with your CPA first. If nothing else, show this to them. If you would like a copy of the IRS Private Letter Ruling 824-6013, just shoot me a message afterwards, mswanson@advocatecapital.com, and that will be available to you at the end of this end of the presentation. All right, generally next recommendation, update your fee agreement to enable interest pass-through. We see clients come to us who decide, okay, I finally decided I'm going to use a loan with interest pass-through, but guess what? All of their cases are signed up with a fee agreement which doesn't allow for the pass-through of interest to their cases. It's really important you disclose that to your client up front. Here are all the expenses you might have at the end of the case and you're responsible for, including borrowing costs if we choose to fund your case with an outside lender. So leave the door open to yourself for the future to potentially fund your cases and pass the interest through, even if you don't want to do so today. It costs you nothing to change your fee agreement today. It costs nothing to do that. It's in there, so if you choose to move forward with that option in 2 or 5 or 10 years, you could immediately fund all of your cases all at one time and get access to the capital in one lump sum. Many new clients of ours come to us, they haven't done that, so they have to just put their toe in and start funding new cases as they go through their inventory, as they change it. If you would like sample pass-through interest language, I can send that to you. Just shoot me an email and we'll get you a copy. Another general business concept is training. It's very important to provide the right training for your staff. As you grow, jobs can outgrow people. You need to be providing the training for folks, if your business is growing, as they move to maybe more and more responsibility. There's a common mistake we see made, which is promoting the receptionist to CPA or to controller. That's a mistake. So it's important to select the right people, but also if you're going to have them increase in their level of responsibility, it's your responsibility as the owner to provide training. We have been using a service called lynda.com, L-Y-N-D-A.com. Love it, phenomenal. I recommend you look it up. Not expensive, tons of topics. You can track and see what training people are taking, this kind of thing. A lot of different courses your employees could be learning from at very low cost. They can do it right at their desk. All right. Financial statements. You should read your financial statements every month. every single month. It should be your income statement, your balance sheet, and your cash flow statement. Now, if you've not been doing that, you probably won't even know what you're looking at first, right? So hire your CPA to sit down and say, hey, I want you to sit down, let's look at last month's financial statements, and I want you to walk me through and explain to me what I'm seeing. Ask questions. Do that over a period of time, and you'll get better and better at it, and you'll know what questions to ask, and you'll be able to spot trends. Annual review of financial statements is not frequent enough. I think you need to do it monthly. I review the financial statements of our business every month, and I probably spend about 4 hours doing that. I'm poring over every detail. That's your responsibility as the effective CEO of the business to be reviewing those. The importance of doing it monthly is that, first of all, you get in a routine, you'll learn, you retain information. If you do it once a year, you're going to forget what an income statement is anyway. The other issue about doing it monthly is that you spot trends, right? You could take your income statement, for example, drop it into Excel, have a column for each month, have your CPA or your assistant create graphs for you. You can spot trends up and down in various areas and spot problems that are coming up, or ask questions. Why has our postage doubled in the past year, but the law firm hasn't? Send someone off to look into that, etc. So look at your financial statements every single month. You should also be the person at your law firm, assuming you're the owner of the law firm, you should be the person opening and reviewing the bank statements. You've probably heard these stories. We hear about them, oh gosh, a couple times a year, and see it in the news where employees embezzle from law firms. It happens all the time. It's usually the person you went to high school with and trust the most that's going to do this, and they either get a substance abuse problem or they have an abusive significant other who twists their arm into doing it. One of the preventive things you can do to protect them from themselves has to do with a bank statement. So every month you should require that your bank statements are brought to your office in a sealed envelope. They're not allowed to open the envelope, and you open them and review them. And what you want to do is, you might not understand everything, you want to circle 1 or 2 items and put it back to your bookkeeper and say, what are these? Bring me the documentation for these expenses. Just 1 or 2, maybe 3 a month. And what that does is lets them know that you're watching and you're paying attention, right? And it's much more difficult for them. It's kind of a preventive thing. You're going to save them from themselves. The other thing is, in the law firm, the person who writes and signs the checks should not be the person who balances the checking account. It's hard, I know, if you have a small staff. That should be 2 different people, and you can outsource that, right? So if you have a bookkeeper who's writing the checks, pay an outside service to balance your checkbook every month. You don't want the person writing checks to also be the one balancing the checkbook. There's too much opportunity for fraud there. Hope that helps you. Okay. You want to watch for liens on your law firm. How many of you know if there's a lien of any kind filed on your law firm right now? Our experience is that there probably is one, and you probably don't know about it. So many times people apply and we ask them, any liens filed on your law firm? No, I don't think so. I have a line of credit with the bank, but I'm pretty sure that's a personal guarantee. Well, odds are your bank has filed a lien on you. And odds are, if you had other banks in the past, they probably haven't terminated them when they should. So use Westlaw or Lexis, delegate this to your assistant. Hey, every quarter, go on, I want you to do an adverse filing search on the law firm and on me as a law firm owner. And you'd be surprised. We see fraudulent filings, we see mistakes, we see failure to terminate. And the reason you want to keep that clean is that can really slow things down. If you go to apply for a commercial loan and there are 3 liens out there from former lines of credit, you know, that could take you weeks or months to get those cleared with the former lenders. So it's a lot easier to know what liens, UCCs have been filed on you and your business. Just do it quarterly. It takes almost no time. This is the second of the 2 most important things I can tell you today, and it is to build net worth outside of your law firm. So the societal value of the work that you do as a contingent fee law firm is absolutely invaluable. You are the keys to the courtroom for your clients. You know that because you fight for them every day to get some semblance of justice for them economically. However, your law firm economically, the greatest value of being the owner of the law firm is in the ability to pay yourself and build net worth outside the law firm. There are a very sad number of experienced, talented, hardworking, honest, wonderful plaintiff lawyers, some of them award winners and presidents of the associations, who are broke. when it comes to looking outside the law firm. They've just left everything in the law firm. They've let the law firm not only absorb all their time and energy, but all their money too. And the sad part is they're going to have to die at their desk. Now, you might not plan to retire. That's okay. I'm not sure I'm ever going to retire, but I want to have that option because I might get tired eventually and say, you know, I think I want to slow down. And the only way to do that as a contingent fee lawyer really is to build net worth outside the law firm. Could you sell your law firm in 5 years? Yeah, maybe. What you're essentially going to be doing is kind of a co-counsel or fee sharing where you take your case inventory and a lawyer down the street will say, yeah, I'll work on it and I'll pay you 25% of the fees or whatever. So it's not really selling the law firm. There's very little brand or enterprise value in your law firm because it's probably named after you, Smith & Smith. So what good is Smith & Smith brand to someone down the street? You know, they have their own brand. So please build net worth outside the law firm, and the way you do that is to pay yourself, budget the law firm expenses such that you can pay yourself, and every year you should look at your personal and financial statement and you should see the number growing, and that's what's best for you and your firm, family. Actually, it's also what's best for your clients, right? A broke lawyer cannot prosecute their cases appropriately for their clients. They can't do it. There are too many law firms where they don't have the cash this week to hire the expert witness, so we'll delay it for a week, or we'll use that not as good witness that will work on a contingent basis. Okay, that's underserving your clients. So build net worth outside your firm so you don't have to do that. All right, now the next set of recommendations have to do with if you are considering a capital transaction for your law firm. Now, because you can't sell stock in your law firm to a non-lawyer unless you're in Washington, D.C., it's difficult to raise growth capital for your law firm. So for the most part in this market, people have used debt to do that. So if you're considering a capital transaction, it's almost certainly not a sale of stock. It's going to be a loan. First thing to do, get a term sheet. So a term sheet is an outline, an overview of all the terms of a potential loan. Remember that bankers are sales reps. They're out there to try to drum up new business, and they're incented to do that. And they may forget to mention a few of the details in the deal that are going to be in the loan documents when you start talking about terms. So if you apply for a line of credit, get a detailed term sheet that should outline all of the details, the collateral, the pricing, the fees, the term, all those things should be signed by an officer of the bank or the lender. Another bit of advice on borrowing money. If you're going to borrow money for your law firm, do your best to match the loan terms, the length of the loan, with the expected benefits. Try not to borrow long-term in order to obtain short-term benefits. Sometimes a law firm will say, I want to get in the Mass Tort. They'll go to a Mass Tort Made Perfect or some other conference, and they know they can buy into cases or acquire cases at a certain dollar per case, whatever it might be. They do some math. They say, hey, I'm going to borrow $1 million. I'm going to buy advertising. I'm going to sign up this many cases. I'll turn that $1 million into $3 million. Well, maybe, but maybe not. Maybe 3 months later, they've spent $1 million in advertising. They still owe the $1 million, and yet they don't have the case inventory they thought they were going to have. And they may take years to pay off that debt when the benefit's long gone. It's similar to going out to dinner tonight and buying dinner on your credit card and then taking 5 years to pay the balance off. And what was the real cost of dinner? A lot more than you thought it was because you're paying all that extra interest. So do your best. If you have a short-term need or benefit that will be coming to you, try to do short-term borrowing and have a plan for retiring the debt when the benefits are done. Coming into you. All right, next is debt is not equity. Okay, debt is not equity. Remember the balance sheet, we saw liabilities, that's debt, and we saw equity, right, which is the paid-in capital or the retained earnings of the business. So to grow a business rapidly usually requires more risk type of capital, and that's usually equity. So equity is the most expensive capital you can obtain for your business. But like we said before, it's very hard to find equity, really, for your business. Very few people, other lawyers, are going to invest risk money into your law firm. If they have excess cash, they're going to invest it in their law firm. So most likely, if you try to access capital to grow, your options will probably be some expensive form of debt. The problem can be with that is that debt does not function like equity functions. So an equity investor in a business shares on a pro rata basis the profits, but also the losses, right? It's risk capital, okay? If I own 10% of a business, I have a claim on 10% of the profits, but I also have to share in 10% of the losses. Well, debt, when put in place in the law firm by a secured lender who's filed a UCC-1 financing statement on the law firm's accounts receivable, that lender does not view that as a risk investment, right? So if you're going to use it like risk capital, you're going to use it to go off in a new direction or grow the business super fast, whatever it might be, start taking on additional risks, that can be very, very risky for you, because the secured lender to a law firm, if they're in first position, under Article 9 of the Uniform Commercial Code, has a lot of power and authority that an equity investor doesn't have. And you would have to cut back on your salary and your marketing and your team and your rent and all these kinds of things to make that payment to your secured lender, because if you don't make that payment to them, they have the ability to essentially, if you default, claim all the accounts receivable for the business in order to get repaid. So that can have the effect of shutting you down. If nothing else, getting up to here where you're barely making any money off your own law firm. We've seen that. We've seen high-priced lenders come in, loan a law firm way too much money, and we've seen the lender making more money off a law firm than the partner. We know because they come and apply to be a client, so we see their income statement, we see how much they're paying their lender every year, and we see the tax returns of the partner and how much money they're making, and the law firm and the lender ends up making more than the lawyer does. Very sad. And it's because they've approached debt as if it's equity, but it does not function like equity, so try not to use it as equity or as risk capital. You'd be surprised how few lawyers read loan documents. It's surprising to me. Very surprising, excuse me. Sorry about that. Getting over a cold. Fortunately for you, you can't catch a cold through a webinar. Okay, it's important to read contracts and loan documents if you're going to take out a loan. It's boring. You might not know what you're reading because you're probably not a contracts lawyer, but read them. If you can't understand them, hire a lawyer to do it for you. Most likely, you're not going to be able to redline, the documents a lot because that's just not something you're normally able to do. You can't take your Visa or your MasterCard, fine print and redline that. It won't work. But at least you'll know what the documents say. We've seen law firms come to us say, oh, I have a loan with such and such, my interest rate's 10%. And we look at the loan documents, they're actually paying 20% because they didn't read them, or there are fees built in or other things they weren't expecting. So read the documents and ask questions and get the right legal help. So if you're going to have a lawyer look at it, it shouldn't be your partner who's also a PI attorney. Hire the right attorney down the street, somebody who's been reading contracts. That has a couple benefits. First, someone who's reviewing loan documents all day, every day, they know what the market is, right? So they know what market standard documents look like, and they're going to be able to help you choose your battles. They'll say, no, this covenant's going to be in every commercial loan you're ever going to see. Don't even bother fighting it. If you don't like it, don't take out the loan. Other areas, they might say, well, this is a very unusual covenant, and you should push back on that. And we don't see that happen very often. So the right attorney helps you understand the document, but also get a sense of what is the market for the terms and conditions of the documents and where to push back. Pretty simple one here. Don't borrow too much money. I mean, it's kind of basic. Your parents probably told you that. Try not to borrow any if you can. If you do, do it for case expenses only. I recommend you keep your debt at your law firm under 1/3 of your average annual fee revenue. So if you're grossing $1 million a year in fees, you should not need to borrow any more than $350,000 and primarily do it to fund your case expenses because all the interest can go through your cases. We see lenders out there who are getting aggressive again, like we saw in 2006 and 2007, who are saying to a law firm, oh, you're grossing $1 million a year. Well, your case inventory is very valuable, and of course that's flattering. We'll loan you $1 million or $1.5 million, and the law firm thinks, wow, I'm special, great, I'll take it. And before they know it, they haven't read the fine print, and they're making ginormous interest payments. That's a non-technical term. So keep your debt to, I think, a maximum of 1/3 of your annual revenues. If you need to borrow more than that, get some help financially. Why would you need more debt than that? Yeah, you might want it for your case expenses, but beyond that, you shouldn't need it. If you're going to borrow from a non-bank lender, ask about funding sources. Where do they get their funding? This became a very important question in the last downturn, economic downturn. It's been a while, but in 2008 and 2009, many of the non-bank lenders were backed by hedge funds and private equity funds, and that money dried up overnight. And many law firms saw their line of credit get pulled overnight, because the lender's funding got pulled from their investors or hedge fund or private equity fund. So ask about funding sources and understand the risks there that could, in a downturn, could dry up. Also check references. By all means, ask a lender for references. They should be able to provide the names and phone numbers of at least 3 other plaintiff lawyers that they've been providing capital to for at least 2 or 3 years, and call and ask them, how's it been going? Did they do what they said they were going to do? You know, how's their customer service? Things like that. So check references, or just have your team check them for you. If you're going to borrow from a bank, you can check the bank out at fdic.gov. Do the search there. You can look up the bank, look at their financial statements. Are they making money? Are they not making money? You know, if you get a loan from them, they're not making money, and they get gobbled up. Now you're dealing with some other bank you weren't expecting. So I wouldn't borrow money from a bank that's losing money. You're probably going to be changing soon anyway. Okay, fixed fees. We'll talk about that a little bit. Fixed fees are one of the ways that lenders can really turn up the yield on the loans they make. We'll look at an example. I'll show you what I'm talking about. So imagine there's a line of credit for $500,000. There's an annual fee of 2% and an interest rate of 5%. Now, let's say the law firm, in the first case, averages $500,000 on the line. So they borrow all $500,000 on day one. They keep it there. Their all-in rate for that in a year is pretty easy to calculate. It's 5 plus 2. It's 7%, right? Now, let's say the law firm only borrows $250,000. They borrow $250,000 on day one. They keep it at $250,000 the full year. What's the rate? Well, that rate's much higher. The rate is actually 9%, because that 2% annual fee is only spread over $250,000, not $500,000. So banks and lenders will try to get you to agree to an annual fee and try to get you to agree to a line of credit larger than you probably need. And the reason for that is what I just explained. So by looking at that example, 9% is 29% higher than 7%. So that second scenario, where the bank only has to put out $250,000, their effective yield on that loan is 29% higher, right? By having that 2% fee and having you agree to pay that on a line larger than you actually need. So be careful of fixed fees. Try not to pay them at all, but if you are, try to size the line to your needs so that you're not paying a higher effective annual interest rate. Okay, so what? Well, so what is that if you don't get this right, it doesn't matter how good a lawyer you are. If you don't get the business part right, it doesn't matter. It doesn't matter how much you care, how passionate you are, how smart you are. If you don't get the business part right, you're not going to be an effective advocate for your client in the courtroom. You're not going to be able to prosecute the cases the way they need to financially, and you're not going to be able to serve them the way I know you want to. So I hope this presentation has been beneficial to you. I hope you did learn one new thing and have 3 takeaways that you wrote down. You can take those to your law firm and apply them. If you need help, I will do it for free, provided you're a plaintiff lawyer. For your defense, forget it. My email address is on the screen. We will send you a link to the recording of this video as a video, YouTube video, and below the video there will be a link where you can also send me a message. If you'd like a copy of How David Beats Goliath, you'd like to read it electronically, it's available on Amazon, iTunes, Barnes & Noble. I donate the profits. More available about the book at howdavidbeatsgoliath.com. And like I said, if you attended today, send me a message. I'd be happy to send you an autographed copy. So I'm going to look down and see if we have any questions. Let me see. Oh, somebody wants a book. Okay, will do. His name is Bill, and Bill, I'll send you a copy. Anybody else have questions? Okay. You're welcome, Paul. Glad you enjoyed the presentation. Any other questions? Give you a chance to ask 1 or 2 more. Very good. Okay. Well, it doesn't look like there are any questions coming in. Thanks for joining us today. Thank you for the work that you do in your community to help your clients. Most people don't know what you do, right? We know that you help people all day long. So thanks for the dedication and the time and energy you spend doing that. And if we can be of support to you in any way, again, if you have a question about something, you don't have to be a client of ours, shoot me an email, and we can jump on the phone and I can try to help you out. I'll do that for free. So, okay. I think we're all done for today. Have a great rest of your day. Take care.